It's a great pleasure to have as our luncheon speaker today Dr. Robert Carroll, who is the current Deputy Assistant Secretary, Office of Tax Analysis, the Treasury Department. It's a position he's held since November 2003. And as you know, Bob provides economic advice analysis to the administration on all aspects of federal taxation. He's responsible for the development, analysis, and implementation of federal tax policies and programs. He's also worked at the Tax Analysis Division of the CBO. He's served as senior economist with the President's Council of Economic Advisors. And after receiving his PhD from Syracuse University, worked as financial economist at the Office of Tax Analysis Revenue Estimating Division and as manager of policy and regulatory economics at Ernst & Young. In these roles, Bob has worked on a wide variety of policy issues, including tax simplification, the effects of investment incentives, international aspects of taxation, retirement security issues, and the distributional effects of taxes. He's especially well known for his work on the elasticity of taxable income, the effects of taxes on entrepreneurship, and the effects of dividend tax relief, all of which were discussed in the sessions yesterday, as well as for important contributions on state business tax climates, and Peter Muskowski's favorite contribution, an empirical piece that verifies the new view of the property tax. We're delighted to have Bob here today to offer his perspectives on fundamental tax reform.
Thank you very much for that very kind and generous introduction. The title of the conference is the known, the unknown, and the unknowable. One thing that I certainly know is these are very nice facilities. In preparing my remarks, one thing that kind of occurred to me is I think it was on Tuesday, perhaps, in the Washington Post. I forget which section. It should have been in the style section. There was some attention drawn to a recent video. A video by a dean of the Columbia School of Business, what some people call the Glenn Hubbard video. And it did occur to me that perhaps the showing of that video might be rather interesting entertainment during lunchtime, but I'll do the best that I can. Before I start my remarks, I especially want to thank the organizers of this conference and at the Baker Institute. The subject of tax reform is very important, a very important subject, and the Baker Institute should really be congratulated for bringing together such a fine group of individuals to discuss this issue. I also want to personally thank George Zodro and John Diamond, not only for George's very nice and generous introduction, but also for the very fine work they've been doing for the Treasury Department on tax reform. As some of you know, the Treasury Department provided a dynamic analysis of the options for the President's tax reform panel that were presented to the Secretary back in November. George and John were essential for getting that work done, and we continue to work with them as we embark on creating a new dynamic analysis division at the Treasury Department. Often when I attend these types of conferences, I listen to folks from academia provide their perspective on how the latest research informs, or in some cases should inform, the analysis that government economists provide to policymakers in Washington. In this instance, the roles are a little bit reversed. I have the opportunity to describe what we are working on in Washington, D.C. at the Treasury Department and tell you about some of the things we have done to continue to integrate the latest research and thinking in academia more directly in our work. In the last decade and a half, in the decade and a half that I've been in Washington, primarily with the Treasury Department, in a variety of roles, there has been a substantial evolution in the thinking underlying and the framework used to analyze tax policy changes, both the revenue effects of tax changes and other types of analyses. This evolution has been a reflection of the research that has been presented at conferences, published in the academic journals, and used in PhD programs, and the contributions that some at the Treasury have made to the literature. When folks were working on the Tax Reform Act of 1986, a shift had already begun in the academic literature suggesting that households and businesses responded to tax rates in important ways. The rate reductions in capital cost recovery provisions in the 1981 Act reflected this view to some extent. Prior to this period, however, saving was generally thought by many to be relatively unresponsive to changes in its after-tax return, and business investment unresponsive to changes in the cost of capital. Labor supply decisions were thought not to be responsive to changes in marginal tax rates to any great extent until the work of Jim Heckman in the early 1980s. Many other dimensions of labor supply were still largely unexplored. The research finding large responses for capital gains and charitable giving date back a bit earlier. But I think it is fair to say that prior to the early 1980s, many, including those in government providing analysis to policymakers, had the view that a variety of economic decisions were not particularly sensitive to changes in marginal tax rates, and certainly did not have the view that saving and investment was particularly responsive to changes in its tax treatment. The 1986 Act probably came as close as we ever have to the economist's ideal of taxing comprehensive or Haig-Simon's income. The tax base was broadened, made more encompassing, and focused on taxing income. Tax rates on individuals came down, tax rates on capital income went up. Income generally was more comprehensively and uniformly taxed. The goal was to tax the return to investment more uniformly to improve the intersectoral allocation of capital, with little focus on the intertemporal dimension. All through the 80s and into the 1990s, the research continued to move in the direction of finding that individual and business decisions were more responsive to changes in tax treatment than previously thought. What was the catalyst at work here? Well, research began to use large microdata files, first cross-sectional, then longitudinal data, to more carefully examine and quantify how tax rates affect various individual and business decisions. Econometric techniques became much more sophisticated. I already mentioned the early literature on the responsiveness of capital gains and charitable giving, incidentally, using primarily tax return data residing at the Treasury Department. This labor supply literature was finding greater responsive for secondary earners. The earlier literature on the responsiveness of savings had relied on time series data and generally found that savings was relatively unresponsive to changes in its after-tax return. But detailed analysis of IRAs and 401ks, although still very hotly debated, revealed in some cases considerable responsiveness. Importantly, investment has also been found to be more responsive than initially thought. I don't see Kevin Hassett here today, but he has clearly contributed to this view. This research has been followed by a growing literature on the taxable income response, a more reduced form approach, encapsulating a variety of taxpayer responses. There is also an emerging literature on entrepreneurship that finds that lower tax rates increase the probability of becoming an entrepreneur, increase the likelihood that they hire workers, that they invest, and that they grow. Of course, this is not to say that all elasticities 10 to 1, or that there still does not remain considerable uncertainty over the results reported in many of these areas. And in some areas, more recent research has shifted back in the other direction and has found smaller responses. This growing empirical-based research on the responsiveness to tax rates has coincided with the development of numerically based general equilibrium models of the economy that emphasizes the intertemporal aspects of consumption, investment, and labor supply decisions. The research using these models have shown that the tax system influences key intertemporal decisions and can have profound effects on the longer-term economic growth and impose substantial costs to the economy. A series of papers have also focused on the intertemporal aspects of taxing capital income and found that under certain assumptions, the optimal tax on capital may well be zero or even negative. But almost as soon as the 1986 Act was enacted, it began to unravel. Over a period spanning more than a decade, we have seen the tax base become more narrow as various tax preferences have been added back to the tax code and others expanded. But this research has served as a basis for some of the shifts in policy. The tax rates on labor first rose, but more recently in 2001 and 2003 were reduced. We have seen the tax on key aspects of capital income fall. First, the maximum 20% rate on capital gains enacted in 1997, and more recently, the 15% tax rate on both capital gains and dividends enacted in 2003. We have seen increasing consideration of faster write-off investment, an expansion of Section 179 expensing for investment equipment for small businesses enacted in 2001, the enactment of bonus depreciation, albeit temporary, and now sunset. These provisions help to encourage investment and had at their intellectual underpinnings the notion that investment could be encouraged by reducing the cost of capital. There are continuing murmurs in the business community and elsewhere over corporate tax rates that are too high relative to our major trading partners. The Office of Tax Policy at the Treasury Department and in other policy shops in Washington have integrated a great deal of this research and thinking into the analysis that they provide to inform policy discussions. The taxable income elasticity is used when estimating the revenue effect of changes in tax rates. The charitable giving elasticities reported in the literature are used to analyze the effect of proposed changes in the charitable deduction. The capital gains elasticities are used in the work product of the office. Changes in the estate tax are assumed to affect the level of charitable giving, as it influences how much individuals who are likely to be subject to the estate tax give away prior to death. And so it goes. Behavior is at least contemplated for virtually all of the proposals that the Treasury Department analyzes and incorporated where thought to be relevant and supported by empirical evidence from the literature. From the excise tax on bows and arrows and fishing tackle boxes to changes in the tax treatment of health care to changes in tax rate schedule, behavior is seriously considered in our analysis. Incorporating these responses is important because the failure to do so gives an inaccurate depiction of the effects of policy changes. This is a somewhat obvious point, but worth highlighting. Consider a proposal to increase tax rates without incorporating the associated reduction in reported taxable income. With the higher tax rates, the revenue gain from the higher tax rates would be overstated. Policymakers would be left with the mistaken impression that the policy would raise more revenue than would actually come into the Treasury. The deficit would be higher than they would have anticipated. Equally important, policymakers would not have the information to properly compare and consider the trade-offs between different policies. Not all tax cuts or tax increases are created equal. Some impose higher costs or provide lower gains to the economy than others. Failure to fully include the behavioral responses introduces biases into policy decisions. Policymakers might be willing, for example, to accept tax rate increases if they raise less revenue than initially thought. But just factoring in behavioral responses as we do now still tells a story that is incomplete. As this audience knows well, the welfare cost of taxes is related to the square of the tax rate. Incorporating behavioral responses might provide a better estimate of the revenue cost, but it leaves out an important component of the higher cost of tax rates. That said, and just as an observation, if economists have not been very good at explaining to non-economists why border adjustments should have little or no effect in the context of tax reform, it is quite difficult to see how we're going to get them to buy into considering changes in the welfare cost of taxation in their decisions. I think Alan Biard, who I had the pleasure of working with at both CEA and at Treasury, can attest to this very significant communications hurdle. Now let me say a few words about the Treasury Department's initiative to expand its capability for dynamic analysis. Since the initiative was announced with the release of the President's fiscal year 2007 budget in early February, I have grown to better appreciate the different perspectives brought to this issue. There are some who have a long-standing interest in the subject, but who are very concerned that we at Treasury may not do this the right way. Then there are others who are concerned that dynamic analysis may politicize the work we do at Treasury. We at Treasury are well aware of the sensitivity of this issue, and we take these concerns very seriously. The real test of this endeavor, how it is received, whether it is a success or a failure, and its longevity depends crucially on its execution. So I'd like to outline some guiding principles that help inform our thinking and we are applying to this work. First, we are starting with dynamic analysis, estimating how major changes in tax policy can affect major macroeconomic variables, the size of the economy. We are not starting with dynamic scoring, although our work may evolve in that direction. Conventional revenue estimates will continue to be produced and relied upon. They will continue to be our bread and butter product. Second, we plan to be as forthcoming and transparent with our approach as possible. The models used for this type of work are sensitive to key assumptions. This has been a discussion over the last several days here at this conference. I've only been able to see a little of that firsthand this morning, but that's clearly a central conclusion. So we at Treasury need to clearly and carefully divulge those assumptions and release enough information regarding the models that we are using so that the results so that those outside Treasury can understand and evaluate the work we are doing. This level of transparency might well be viewed as a departure from how we have proceeded with other types of analyses, such as our revenue estimates, for example. Third, we are very interested in the long-run effects, as well as the effects along the transition path. One of the major benefits and motivations for dynamic analysis, in my view, is focusing the attention of policymakers on the long-run benefits or costs of policy changes. and the trade-offs between different policies. This is in contrast to the 5- and 10-year budget windows routinely used for evaluating the revenue effect of proposals today. Fourth, sensitivity analysis is critically important and will be a central part of our work. As I mentioned, the models used for this type of analysis are sensitive to key assumptions, especially how a tax change is financed. So we need to carefully consider those assumptions and report how the results vary with different sets of assumptions. CBO and the Joint Committee, in some respects, have dealt with sensitivity by using a portfolio of models that each emphasize different dimensions of the analysis. The Treasury is very much playing catch-up and will, at least initially, focus on a more narrow set of policies. So we are unlikely, at least initially, to use a very broad set of models, but we will consider sensitivity of the results to key assumptions in the models that we do use. Fifth, we very much want to have an open and continuing dialogue on our work. This is simply an extension of transparency. Participation in conferences like this and those that Jim Paterba and Martin Feldstein have organized through the NBR over the past several years provide a very constructive environment from which we can openly discuss our work outside the confines of Washington, D.C. The initiative should be viewed very much as building on the continuing evolution of the manner in which we have integrated behavioral aspects of taxation on economic decision-making in our work at Treasury. And it should be remembered that we already exercise considerable judgment in that work, and I would say good judgment, that we already do on conventional revenue estimates and a variety of other analyses. The new dynamic analysis division is a very natural extension of the work we are already doing. The Joint Committee and the CBO have already been doing this type of work for some time. In the case of CBO, they have been doing this work in some respects for many years. In many respects, as I mentioned, we are playing catch-up to these other organizations. This work is also very important to the next subject I'd like to turn to, tax reform. To be clear, tax reform is alive and well at the Treasury Department. As you know, the President's Tax Reform Panel delivered its final recommendation to Secretary Snow on November 1st of last year, and Treasury is busy evaluating those options. They serve as a very firm foundation and a solid starting point for our work on tax reform. But tax reform is a very difficult issue, and is an issue that comes along infrequently, perhaps every 20 years or so. Secretary Snow has directed us to proceed slowly and carefully, to thoroughly consider all options and avenues to reform the tax code with an eye for coming up with a plan that is practical and politically viable. We are not working under any specific public timetable. We very much want to get this right, and will take the time we need to do so. It is important to note that the reasons for reform remain. As you know all too well, the tax system is extraordinarily complex, imposing a compliance burden of taxpayers of about $140 billion per year. Just reducing this compliance burden by 1/3 would produce an annuity to the economy of nearly $50 billion each year, forever. The AMT still looms on the horizon, capturing some $56 million, or 1/2 of all taxpayers by 2016. The benefit of reducing the compliance burden is small in relation to the benefit of reducing the economic costs of the tax system. Some estimates suggest that reform could ultimately increase output by 5 to 10%. In a $12 trillion economy, that would ultimately translate into an increase in output of $600 billion to $1.2 trillion. To be clear, these estimates are for very fundamental reforms of our tax code. And these very fundamental reforms may or may not advance in the political process in Washington. There are many issues that would need to be addressed in a legitimate and realistic proposal. How progressive would the rate structure need to be to address fairness? And what is the extent of transition relief that will need to be provided are just two. But just as an observation, in some of the options the tax panel put forward, they were able to provide substantial simplification, increased growth, increasing output by as much as 6% in some of the options and some of the analyses, while achieving the same or slightly more progressive distribution of the tax burden than we have today, and providing at least some level of transition relief. So long as the tax system continues to fall under its own weight and there are real tangible benefits from reform, tax reform will remain viable both within Washington and outside. As Len reminded me earlier, I am in this very difficult situation of not being able to say anything that is remotely controversial or indicates directionally where Treasury may be going. But with that, instead of watching the Glenn Hubbard video, I'd be happy to take a couple questions.
You intimated that you were building in labor response, labor supply response elements into your analogy. And we were talking yesterday, and then you heard it, about the rather conflicting evidence there is concerning low elasticity or higher elasticity of labor supply. I was inferring from your remarks that you were kind of leaning on the higher side of the elasticity of labor supply. And I was wondering whether you had sort of clear, convincing, straightforward evidence of what backs that up.
Sure, I appreciate that question, and perhaps it offers me an opportunity to clarify. Certainly when we incorporate behavioral responses, what we typically do is we look to the literature and try to take a broad view of the literature and use elasticity assumptions in our work that's representative of that broad literature. In the case of labor supply, to some extent it's indirectly captured in our taxable income responses. So when we're looking at rate changes, we indirectly capture some labor supply responses through the taxable income elasticity. For other analyses where we're directly looking at labor supply responses, we draw generally from the literature. I wouldn't characterize it at the high end, but I also would point out that the elasticities that we do use are higher than zero. Alan.
Is this, yeah, okay. Something it's probably already, it's come up already to a certain extent in the analyses, the dynamic analyses that CBO and the Joint Committee have done. But it perhaps might be a little bit more of a sensitive issue in the Treasury, given that the Treasury is part of the administration. You mentioned this. One of the things that one has to do in dynamic analysis when, say, considering the effects of a tax cut is considering how the tax cut will be paid for at what point in the future. And when CBO and Joint Committee have done it, they've assumed, well, if it's a 10-year tax cut, what happens after 10 years? To what extent do you anticipate that this will be problematic in putting forward an analysis of administration proposals, for example, for a tax cut in the face of an already unsustainable fiscal policy, where presumably you'll have first had to close the model by indicating how you think the fiscal policy will be made sustainable. Presumably you'd already have a model with, say, tax increases or spending cuts in the future. And then you'll have another tax cut, which even with feedback effects presumably will have requirements for additional revenue or additional spending cuts. To what extent do you foresee that this being a public Treasury document will undercut your ability to engage in candid analyses of this kind?
Well, I certainly hope that we'll be able to engage in a candid analysis, and I think my view is that the sensitivity, these models are uncertain, and one of the key assumptions in these models, as you pointed out, and I'm sure has been discussed over the last couple of days, is how the tax changes are financed, whether it's a finance with changes in future changes in government spending, or future tax increases on labor capital, or some combination of both. And I think it's clearly the view to have something that's credible out there, that we have to be sensitive to that sensitivity, if you will, and we have to be forthcoming with those results. Henry?
In a sense, this follows up on Alan's question. The attempt at dynamic scoring that CBO did ended up with a number of estimates that were all very close to the baseline calculations. Some indicated that the fiscal consequences would be larger, some smaller, presumably because of substantial offsetting effects of different tax proposals. A number of elements of tax policy in recent years have been inframarginal and hence have produced income effects but no substitution gains, and therefore have probably reduced labor supply. My question is, do you anticipate that explicitly building those kinds of effects into analysis will have a material effect on internal debates within Treasury, influencing proposals actually made by the administration?
Well, I hope we at Treasury now will be able to lay down a framework where the analysis, the dynamic analysis that we present, will allow the policymakers in place today and policymakers in place in the future to draw contrasts between different policy options. And as your question alluded to, different policies have different economic benefits. Some are more inframarginal than others. Not all tax changes are created equal. And so I think an important part of what we intend to put forward, and part of the dynamic analysis, is to draw those contrasts. The tax proposals in the president's budget focus primarily on, let's say, permanently extending the 01 and 03 tax cuts. Or have different economic consequences, and I think we do want to, in what we put forward, illustrate that. I think that's one of the benefits of what we can do. As my understanding of what CBO and the Joint Committee have done, have kind of looked at the total, the total budget, the entire set of proposals included in the president's budget, not only on the tax side but also on the spending side. And they didn't distinguish, as I understand it, between different policies. And that's an area where I hope we can make a contribution.
Well, I think one of the benefits of doing dynamic analysis would be to look at the benefits and costs of a number of specific tax provisions. It sounds like you're looking at major changes, but there are a number of tax expenditures that would benefit from looking at the benefits and costs, such as mineral depletion, R&D credit, and was wondering at what point are you going to go down to that level?
That's an excellent question. There's a little controversy in digging down into the details, I bet. We're starting off small. We don't even have the division up and going yet. We're committed to putting forward a dynamic analysis of the tax proposals in the president's budget as part of the mid-session review. We still anticipate we'll be able to fulfill that commitment and put that analysis out there. I think initially in the near term, we're going to have the resources to look at major tax policy changes. I think there would be some advantages to, at some point in the future, to drilling down a little bit more deeply and looking at the provisions that are more narrowly targeted. I think that would be quite interesting and add to the policy debate.
Hi. I was wondering, since you're kind of focusing a little bit more on the dynamics and the fact that any one of us has a dynamic he or she lives over many years, whether the Treasury is going to start doing distribution analysis on a lifetime basis rather than just a point-in-time static basis. I think that is very important. Maybe you're already doing this, but I'm not aware of it, but that's very important for thinking about something like going to consumption tax reform.
Yeah, that's. I think the dynamic analysis can help inform the distributional analysis, focusing on the intertemporal issues. One would likely lead one to believe and conclude that more of the tax is more of capital income taxes, for example, might be borne by labor than some of the analysis we've provided in the past generally assume. The work we did for the tax panel, speaking directly to your point about lifetime distributional analysis, one of the distributional analyses that we provided on the tax panel's options did include kind of a 10-year average change because of tax changes, looking at the 10-year average income and 10-year average change for those options. So it's not lifetime income, but it is moving in that direction. That's it's quite an endeavor to try to do that. Quite honestly, I'm not sure that we would be able to do lifetime incidents anytime soon. Well, thank you very much.